Chapter 10. The Inequality of Capital Ownership. Part 1 of 5. The Oldest Divide. Welcome back. If you've been following along with us through the earlier chapters, you'll remember the territory we've covered. We've looked at how big the pile of capital is relative to income. We've looked at how that pile is composed: housing, financial assets, public versus private wealth. And we've looked at how income gets split between those who work and those who own. Today, we go somewhere that I think is, in some ways, the emotional core of this whole body of research. We ask, within the pile of capital itself, however big or small it happens to be, how is ownership of that pile distributed across people? Not how much capital exists, who actually has it. And I want to flag right away, this is where the numbers stop being abstract and start being, frankly, a bit uncomfortable. Because when we talk about the capital-income ratio, or the split between capital and labor, we're talking about averages, about shares of a total. But when we ask who owns the capital, we're talking about individual lives. We're talking about the difference between someone who, at 25, already owns an apartment outright because it was given to them, and someone who, at 65, still doesn't own the place they live in, despite working every year of their adult life. Same economy, same capital-income ratio, wildly different lived experience depending on where you sit in this distribution. Let's start with the headline numbers, because they're worth sitting with for a moment. In the period around 2010, across the countries where this has been studied most carefully, France, Britain, Sweden, the United States, the top 10% of the population, by wealth, owned somewhere in the region of 60 to 70% of all private wealth. The top 1% alone, one person in 100, owned somewhere between 20 and 35%, depending on the country. And at the very bottom, the bottom half of the population, 50% of people, owned in total somewhere around 5% of all wealth, sometimes less. Let's just sit with that bottom number for a second, because I think it's the one that doesn't land properly when you hear it fast. 5% of all wealth, shared between half of all people. If you lined up everyone in a country from poorest to richest and you asked, what fraction of everything that's owned, every house, every savings account, every share, every bond belongs to the first half of that line, the answer is almost nothing. For a huge number of people, net wealth is close to zero, or even negative once you subtract debts from whatever modest assets they have. These are people who, in many cases, work full-time, raise families, pay taxes, and yet own, in net terms, almost nothing of the society they live in. Now here's where it gets historically interesting, because this isn't a new pattern, and it isn't even, by historical standards, a particularly extreme pattern. If you go back to Europe before the First World War, say 1890, 1900, 1910, the concentration was even more extreme. In Britain and France around this period, the top 10% owned closer to 90% of all wealth. The top 1% alone owned roughly 60%. Think about that. One person in 100 owning on their own more than half of everything. And the bottom 50% in that era, essentially zero, not 5%, close to nothing at all. This was a society where, if you were born into the bottom half of the wealth distribution, in Britain or France in 1890, you could work hard your entire life, live frugally, save what you could, and you would, realistically, never accumulate enough to meaningfully change which group you belonged to. Wealth in that world wasn't something you built, it was something you were born into or not. So between roughly 1900 and 1950, something remarkable happens. The concentration falls, quite dramatically. The top 10% share, which had been around 90% in Britain and France, falls to somewhere around 60 to 65% by the 1950s and 60s. The top 1% share falls from around 60% down to somewhere between 20 and 25%. And crucially, the bottom 50%, and especially what we might call the middle 40%, the group between the bottom half and the top 10%, actually starts to own something. Not a huge amount, but something. For the first time in recorded history in these countries, a genuine middle in terms of wealth comes into existence. This is what gets called, in this body of research, the rise of the patrimonial middle class. And I think the phrase is doing real work, so let's unpack it. Patrimonial just means relating to inherited property or wealth more generally. So the patrimonial middle class is, literally, a middle class defined by wealth, not just income. Before the 20th century, you could have a comfortable income, a doctor, a senior clerk, a school teacher, and still own essentially no significant capital. Your standard of living came entirely from your salary, year to year. If you stopped working, you had very little behind you. What emerges in the middle of the 20th century for the first time is a large group of people, often historically estimated at around 40% of the population, who own a meaningful share of total wealth, something like a third of it, mostly in the form of a home, and some modest savings or pension assets. And why did this happen? We've actually touched on some of these mechanisms in earlier lectures, but let's bring them together specifically through the lens of ownership, of who holds what. Three things mainly. First, the wars and their aftermath destroyed a huge amount of the great fortunes, the ones concentrated at the very top, through physical destruction, through inflation eroding bond holdings, through the loss of overseas assets. The very top of the distribution took an enormous hit. Second, the spread of housing ownership. As mortgages became more widely available, and as housing construction expanded rapidly in the post-war decades, ordinary working households, for the first time in large numbers, became homeowners. And a home, for a middle-income household, is capital. It's often the only significant asset such a household will ever hold, but it's a real one. Third, the expansion of pension systems, both public and private, which meant that, for many people, a portion of their lifetime earnings was effectively converted into a form of accumulated capital, even if they never thought of it that way. So you get this historically unusual configuration. The top is compressed, the bottom half remains more or less where it always was, owning very little, but in between, a genuinely new group emerges, owning a meaningful, if modest, slice of the pie. And this is the world that shaped, again, the expectations of people who grew up in the middle of the 20th century. Homeownership felt achievable. A pension felt like a real asset you were building. The gap between people like us and the rich felt large, but not unbridgeable, not the kind of gap where one side owns 60% and the other side owns nothing. And then, from somewhere around the 1980s onward, in the countries where this has been tracked most carefully, the concentration at the top starts rising again. Not back to the 1890 levels, not yet, but rising. The top 10% share, which had fallen to around 60 to 65% by mid-century, climbs back toward 70% or beyond in several countries by 2010. The top 1% share, which had fallen to around 20 to 25%, climbs back toward 30 or higher in some cases. The patrimonial middle class doesn't disappear, but its share of the total pie stops growing, and in some measures starts to shrink slightly, even as, in absolute terms, many middle-class households continue to feel reasonably that they own more than their parents did. And that last point is worth dwelling on, because it's one of the places where this whole conversation gets genuinely confusing for people, and I don't think that confusion is anyone's fault. It's entirely possible, and in fact has been the norm in recent decades, for a middle-class household's absolute wealth to increase. Their house is worth more, their pension pot is bigger, while at the same time their share of total national wealth, relative to the very top, shrinks. Both things are true simultaneously. You can be better off than your parents were, in absolute terms, and further away in relative terms from the top of the distribution than your parents were. This is part of why debates about inequality so often talk past each other. One side points to rising absolute living standards, which is true. The other side points to widening relative gaps, which is also true. They're not contradicting each other. They're describing two different, both accurate, features of the same underlying data. So to summarize where we are, before we go further. First, wealth ownership has always been and remains far more concentrated than income. The top 10% typically own a majority of all wealth, often a large majority. Second, this concentration was at its most extreme in Europe around 1900, where the top 1% alone owned more than half of everything, and the bottom half owned essentially nothing. Third, the middle decades of the 20th century saw the emergence, for the first time in history, of a genuine patrimonial middle class, owning a meaningful share of total wealth, mainly through housing and pensions. Fourth, since the 1980s, concentration at the top has been rising again, even as absolute living standards for the middle have, in many cases, continued to improve. In Part 2, we're going to dig into the mechanism Piketty puts at the center of all of this, the relationship between the rate of return on capital and the growth rate of the economy, but specifically as it applies to individual fortunes. And we're going to look at some genuinely striking long-run data on how this relationship has behaved, not just over the past few centuries, but remarkably, going back to roughly the year zero. See you in Part 2. Part 2, the oldest inequality of all, R versus G, from antiquity to now. Welcome back for Part 2. In Part 1, we looked at the shape of wealth concentration over the past century or so, the fall from the extremes of 1890, the rise of the patrimonial middle class, and the partial return toward concentration since the 1980s. Today, we go underneath that shape, to the mechanism that in this body of research is presented as the fundamental engine driving it. The relationship between R, the rate of return on capital, and G, the growth rate of the economy. We've touched on R and G before in earlier lectures, but today we're going to look at something genuinely remarkable, a piece of data that I think is one of the most striking in the entire book. Researchers have attempted to estimate the relationship between the world rate of return on capital and the world growth rate of output, going back not just centuries, but, in this particular exercise, all the way back to roughly the year zero. 2,000 years of data, or at least 2,000 years of careful estimation, given how thin the historical record gets the further back you go. And here's the finding. For almost that entire span, from antiquity through to roughly the start of the 20th century, the world rate of return on capital sat at somewhere around 4 to 5%. Remarkably stable. Land, the dominant form of capital for almost all of this period, tended to yield returns in roughly this range, across an extraordinary variety of societies, economic systems, and historical periods. Meanwhile, the world growth rate of output for almost this entire span was close to zero. Not literally zero, there were good years and bad years, but averaged over centuries. Global output per person grew at a pace so slow it's almost imperceptible on a chart covering 2,000 years. So for nearly the whole of recorded history, you have R sitting at around 4 to 5%, and G sitting at something close to zero. The gap between them, R minus G, is therefore close to 4 or 5 percentage points for roughly 2,000 years. And then, starting around the 18th and especially the 19th century, with the Industrial Revolution, G starts to rise. Not to 4 or 5%, nothing like that, but from close to zero to somewhere around 1 to 1.5% globally. R, meanwhile, stays roughly where it's always been, somewhere in the 4 to 5% range, maybe drifting slightly lower over the very long run as capital becomes more abundant, but nowhere near as dramatically as G moves. So the gap narrows, for the first time in 2,000 years, from around 4 or 5 percentage points, down to something more like 3 percentage points in the 19th and 20th centuries. And then, in the projections that this research extends forward, into the 21st and 22nd centuries, the expectation, based on demographic projections and productivity assumptions, is that G falls again, back toward 1% or even lower globally, as population growth slows worldwide the way it already has in rich countries. While R, the return on capital, is projected to remain in a broadly similar range to where it has been for 2,000 years, which means the gap, R minus G, is projected to widen again, back towards something closer to the historical norm of 3 to 4 percentage points, or more. I want to pause on this because I think it's easy to let a number like the rate of return has been 4 to 5% for 2,000 years wash over you without really landing. Think about everything that's happened in 2,000 years. The fall of the Roman Empire, the Black Death, the printing press, the discovery of the Americas, the Industrial Revolution, 2 world wars, the Internet. Through all of that, through every one of those upheavals, if you own productive capital, land, and later other forms of capital, the underlying tendency was for that capital to generate a return, for its owner, of somewhere around 4 to 5% a year. Individual fortunes rose and fell, of course. Wars destroyed specific holdings. Revolutions redistributed specific estates. But the underlying rate, what capital in general tends to yield to its owner, has been remarkably resistant to all of this historical drama. And here's why this matters for the ownership question we were discussing in Part 1. If R is reliably higher than G, then for someone who already owns capital, the simplest possible strategy, do nothing, just hold the asset, reinvest the income it generates, tends to grow that person's wealth faster than the economy as a whole is growing. Over 1 year, this difference is invisible. Over 10 years, it's noticeable. Over a generation, 25 or 30 years, a gap of even 2 or 3 percentage points compounded becomes enormous. And over multiple generations, which is the actual timescale at which large fortunes are built and maintained, this compounding gap is, mathematically, the single most powerful force in the entire system. Let's make this concrete with a comparison that I think captures the scale of what we're talking about. Imagine 2 families. Family A starts with a sum of money and simply invests it, reinvesting all the returns generation after generation, earning, let's say, a real return after accounting for inflation of around 3% a year, which is well within the historical range we just discussed. Family B starts with nothing, but every member of every generation works hard, earns a good salary, and the economy they live in grows at, let's say, 1.5% a year. After 30 years, 1 generation, Family A's wealth has grown by a factor of about 2.5. After 60 years, 2 generations, by a factor of about 6. After 90 years, 3 generations, by a factor of about 15. Family B, meanwhile, has nothing at the start of each generation, by definition, since they started with nothing and were asking about the gap, not their absolute living standards, which, as we discussed in Part 1, can absolutely improve in absolute terms even as this relative gap widens. Now, I want to be careful here, because this is exactly the kind of point where it's easy to slip into something that sounds more certain or more deterministic than the actual research claims. This is a description of a tendency, a mathematical pull, not an iron law that operates without exception, and not a claim that every wealthy family maintains its position across every generation. Plenty of individual fortunes are squandered, divided among many heirs until each share is modest, taxed away, or lost to bad investments. And plenty of new fortunes are created from nothing within a single lifetime, as we'll discuss later. The claim is about the aggregate tendency across an entire society over long periods. At the level of any individual family, all sorts of things can happen. But if you add up millions of families and let the arithmetic of R exceeding G run for decades, the aggregate effect on the overall distribution of wealth is the rising concentration we saw in Part 1. There's also a really important qualifier here, which is how much of the return gets reinvested versus consumed. If R exceeds G by 3 percentage points, but a wealthy family spends on lavish living, an amount equivalent to that entire 3 percentage point excess, every year, then their wealth grows at the same rate as the economy, and their relative position doesn't change at all. This is actually one of the reasons inherited wealth tends to concentrate more, not less, as it gets larger. A family with a very large fortune can spend, in absolute terms, an enormous amount, an amount that would be unimaginable luxury to almost anyone else, while still reinvesting the majority of their capital income, because their consumption, however lavish, represents a small fraction of a very large total. A smaller fortune, by contrast, might need to consume a much larger fraction of its capital income just to maintain a comfortable, but not extravagant, lifestyle, leaving less to reinvest, and therefore growing more slowly, relatively speaking, than the largest fortunes. This is sometimes summarized with the observation that, historically, the very largest fortunes have tended to earn higher returns than smaller fortunes, not just because they reinvest a larger share of their income, but also because they have access to investment opportunities and to financial advice and diversification that smaller investors simply don't. Large endowments, certain university endowments and sovereign wealth funds among them, have, over long periods, achieved real returns meaningfully higher than what a typical individual saver, putting money into an ordinary savings account or a standard retirement fund, could realistically expect to achieve. If this pattern holds even approximately, it means R isn't just a single number. It's a range, and where you sit in that range depends to a significant degree on how much capital you already have, which means the gap between R and G can be larger still for those at the very top than the average figures suggest. So to summarize Part 2. First, across roughly 2,000 years of history, the world rate of return on capital has hovered around 4 to 5%, while the world growth rate was close to zero for almost all of that time, only rising meaningfully in the past 2 centuries. Second, this means R has exceeded G by a wide margin for almost all of recorded history, narrowing somewhat in the 19th and 20th centuries, and projected, in this research, to widen again as global growth slows in the coming century. Third, when R exceeds G, wealth that is reinvested compounds faster than the overall economy, a tendency that becomes dramatic over multiple generations, though it operates as an aggregate tendency, not a guarantee for any individual family. Fourth, larger fortunes often achieve higher returns and reinvest a larger share of those returns, potentially widening the gap further for those already at the top. In Part 3, we're going to look at something that complicates this picture in a genuinely interesting way. The rise of new fortunes built within a single lifetime, often through entrepreneurship rather than inheritance, and ask how this fits, or doesn't fit, with the historical pattern we've just described. See you in Part 3. Part 3, Old Money, New Money, and the Global Rich List. Welcome back for Part 3. In Part 2, we talked about the deep ancient tendency for R to exceed G, and what that means for fortunes that simply sit and compound, generation after generation. Today, we look at something that, on the surface, seems to cut against that story. The rise, especially over the past few decades, of enormous fortunes built within a single lifetime, often starting from relatively modest beginnings. And this is genuinely one of the more fascinating tensions in this whole area of research, because both things are visibly true at once. On one hand, you have the deep historical pattern we described, R exceeding G old wealth compounding across generations. On the other hand, if you look at lists of the world's wealthiest individuals, going back, say, 30 or 40 years, a striking number of the very largest fortunes today were not inherited. They were built within the lifetime of the person who holds them, often starting a company from very little. So how do these two facts fit together? One way researchers have approached this is by looking at how the composition of the very largest fortunes, say the global top 100 or so by wealth, has changed over time, comparing roughly the 1980s to more recent decades. And what tends to emerge is that the share of these largest fortunes that can be traced to entrepreneurial wealth created within the holder's own lifetime has been notably higher in recent decades than it was a few decades earlier. At the same time, the share traceable to multi-generational inheritance, while smaller than it might have been a century ago, hasn't disappeared, and in some measures has itself been rising again, as the large fortunes accumulated by entrepreneurs in earlier decades begin to pass to second and third generations. Here's the way I think about this, and I want to be upfront that this is my own framing, not a direct finding from any one study, but I think it helps. Imagine a river. The river represents the total stock of very large fortunes at any point in time. New water is constantly entering the river. From a tributary we might call entrepreneurial creation. New fortunes built from scratch through new businesses, new technologies, new industries. But also, once water is in the river, it doesn't just flow out the other end and disappear. It tends to keep flowing year after year, generation after generation, governed by the R versus G dynamic from Part 2. At any given moment, if you take a snapshot of the river, the water you see is a mixture. Some of it entered very recently, through the entrepreneurial tributary. Some of it has been flowing for decades or longer, inherited and re-inherited. The snapshot doesn't tell you, on its own, how old any particular molecule of water is. And this is why, I think, this particular debate, is inherited wealth still important, or has entrepreneurship made wealth more meritocratic, often generates more heat than light. Because both sides can point to real, true things. One side points to the genuinely remarkable fact that some of the largest fortunes in human history have been built within living memory, by people who, in many cases, started with relatively little. This is true, and it's a real, important feature of the modern economy that simply did not exist at this scale before. The other side points out that, once such a fortune exists, it doesn't somehow exit the R versus G dynamic. It becomes subject to exactly the same compounding logic as a centuries-old aristocratic estate. The founder's children and grandchildren inherit not just money, but a starting position relative to everyone else born in the same year. That is, in relative terms, almost unimaginably advantageous. Both of these things are true about the same fortune, just at different points in time. Let's bring in a concrete historical comparison, because I think it sharpens this. Consider the great industrial fortunes built in the late 19th and early 20th centuries, in sectors like steel, oil, and railways, in various countries during their periods of rapid industrialization. At the time these fortunes were being built, they would have looked, to contemporaries, exactly like the new money, built in one lifetime story we're discussing about more recent fortunes. 100 years later, the descendants of these industrial fortunes are, in many cases, simply part of the broader landscape of wealthy families, their wealth diversified across many types of assets, no longer tied to the specific industries their ancestors built. From the perspective of someone living today, these are old money families. From the perspective of someone living when those fortunes were first built, they were new money, built within a single remarkable lifetime, by individuals whose contemporaries would have marveled at how quickly they'd gone from modest beginnings to extraordinary wealth. In other words, new money doesn't stay new. It's not a permanent category. It's a snapshot, a description of where a fortune happens to be in its own life cycle at the particular moment you happen to be looking at it. Give it 30, 40, 50 years, and assuming it isn't dissipated, taxed away, or lost, new money simply becomes old money, the only difference being which generation is currently managing it and how diversified its holdings have become. This connects to something genuinely relevant happening right now, in terms of current events. A significant number of the individuals who built extraordinarily large fortunes in the technology sector over roughly the past 30 to 40 years are, as we speak, at the stage of their lives where questions of succession, how this wealth gets transferred to the next generation, what structures it's held in, whether it goes to children, to foundations, to charitable causes, are becoming live, practical questions, not abstract ones. How these decisions play out across dozens of enormous fortunes over the coming decades will be a major factor in whether the entrepreneurial tributary we discussed continues to dominate the composition of the largest fortunes, or whether, as these fortunes pass to second and third generations, the picture starts to look, once again, more like the multi-generational, R versus G-driven pattern that dominated for most of history. I want to bring in one more angle here, because it's something that doesn't get discussed as often as it probably should: the global dimension. Everything we've discussed so far has mostly been framed at the level of individual countries, the top 1% in France, in Britain, in the United States. But capital, especially large amounts of it, increasingly doesn't sit neatly within national borders. A meaningful share of the wealth held by the very wealthiest individuals and families globally is held through structures, certain types of trusts, holding companies, and accounts in jurisdictions specifically chosen for favorable tax or regulatory treatment that make it genuinely difficult for any single country's statisticians to capture in their national wealth surveys. And this creates a real measurement problem, one that researchers in this area are quite open about. The wealth concentration figures we discussed in Part 1, the 70%, the 35%, these are generally considered, by the researchers who produce them, to be underestimates of true concentration at the very top, precisely because some portion of the wealth of the wealthiest is, by its nature, harder to observe in standard data sources than the wealth of, say, a middle-income household whose primary asset is a home registered in the local land registry. Estimates of how much wealth globally is held in this harder-to-observe way vary considerably, and naturally, by their nature, are themselves estimates, but the studies that have attempted this suggest the amounts involved are substantial, equivalent to a meaningful share of global gross domestic product. If even a portion of this is concentrated among the wealthiest households, as seems likely given who has access to the structures involved, then the true level of concentration at the very top is probably somewhat higher than the figures in Part 1 suggest, though by precisely how much remains genuinely uncertain. So to summarize Part 3. First, a significant share of the largest fortunes today were built within a single lifetime, often through entrepreneurship, a genuinely new feature relative to earlier centuries when almost all great fortunes were multi-generational. Second, once such a fortune exists, it becomes subject to the same R versus G compounding dynamic as any inherited fortune, meaning new money tends to become old money over subsequent generations, just as today's old industrial fortunes were once new. Third, how the current generation of large entrepreneurial fortunes handles succession over the coming decades will significantly shape whether the composition of top wealth continues to look new, or reverts toward the historically more typical multi-generational pattern. Fourth, a portion of global wealth, concentrated among the wealthiest, is held in ways that are difficult for standard statistics to fully capture, meaning true concentration at the very top is likely somewhat higher than headline figures suggest, though the exact scale remains uncertain. In Part 4, we're going to turn to something Piketty spends real time on in this chapter, the question of policy, specifically the idea of a progressive tax on capital itself, not on income, not just on inheritance at the point of death, but an ongoing tax on the stock of wealth, and the arguments on multiple sides about whether this is a workable response to everything we've discussed. See you in Part 4. Part 4, The Tax That Time Forgot, a progressive levy on capital. Welcome back for Part 4. We've spent 3 parts building toward this. The concentration of wealth ownership, the R versus G dynamic that drives it over time, and the mixture of old and new fortunes that make up the top of the distribution today. Now we get to the policy idea that this chapter is, in many ways, building toward: a progressive, annual tax on capital itself. And I think it's worth being really precise about what this idea actually is, because it gets confused, constantly, with other things that sound similar but work quite differently. This is not primarily a tax on income, the money you earn or receive in a given year. It's not primarily an inheritance tax, applied once at the point someone dies and passes wealth to the next generation. It's an annual tax on the total stock of what you own, your net wealth, assessed every year, at progressively higher rates as that stock gets larger. Own a modest amount, pay nothing or close to nothing. Own a very large amount, pay a small percentage of that total every year for as long as you continue to own it. The logic connects directly to everything we've discussed. If R tends to exceed G, and if that gap drives the long-run tendency toward concentration we saw in Part 1, then an annual tax on capital, even at a modest rate, acts as a permanent, ongoing adjustment to R, specifically for the largest holdings. It doesn't need to be large to matter. If R is, say, 4 or 5%, a tax of 1 or 2% on the very largest fortunes, while leaving smaller fortunes largely untouched, meaningfully narrows the gap between R and G for those at the top, without eliminating the incentive to invest altogether. Now, here's where I think it's really important to slow down, because this is exactly the kind of idea that gets presented, by supporters and critics, in much more simplistic terms than the actual discussion warrants. Let's go through the genuine, serious considerations on multiple sides, because I don't think there's a clean answer here, and I'd be doing you a disservice if I pretended there was. The case for: if the underlying R versus G dynamic is real and operates over decades and generations, then policies that only address income, leaving the underlying stock of wealth and its tendency to compound, untouched, may simply be too weak to meaningfully affect long-run concentration. An annual wealth tax, the argument goes, addresses the actual mechanism, the compounding of the stock itself, rather than just the flow of income that stock generates in any given year. There's also a fairness argument some make, that a very large fortune confers significant advantages: security, access to better investment opportunities, political and social influence, that exist independently of whatever income that fortune happens to generate in a particular year, and that taxing the stock directly is a way of addressing those advantages. The case against, and there are several distinct strands here, not just one. First, the practical challenge of valuation. Income is relatively straightforward to measure. Money arrives, you can count it. The total value of someone's wealth, particularly when it includes ownership stakes in private businesses, art, intellectual property, or other assets that don't trade on a public market every day, is genuinely difficult to assess accurately every single year for tax purposes. Second, liquidity. Income arrives as cash, which can be used to pay a tax on that income. Wealth, especially wealth tied up in a family business or a large shareholding in a company someone founded, isn't cash. An annual tax on the value of such holdings could, in principle, force owners to sell portions of businesses simply to pay the tax, even if the business itself isn't generating much cash income in a given year. Third, capital mobility, which we've touched on before. Wealth and wealthy individuals can relocate across borders far more easily than, say, a factory or a piece of land. A wealth tax introduced in one country, without coordination elsewhere, risks simply relocating the wealth and the economic activity associated with it, rather than reducing concentration globally. And then there's a fourth consideration, one that I think is genuinely the hardest to resolve, because it's not really an empirical question, it's a question about what we think capital is for, economically. Some economists argue that the prospect of accumulating and keeping a large fortune is itself an important incentive for the kind of risk-taking, the founding of new businesses, the long-term investment that drives the entrepreneurial wealth creation we discussed in Part 3. If a meaningful annual tax on large fortunes reduces the ultimate size of the fortune an entrepreneur can expect to retain, does this measurably reduce the incentive to take the kinds of risks that, occasionally, produce the transformative businesses that drive the growth rate itself higher? Others argue this concern is overstated, that the incentives that matter for entrepreneurship operate at much smaller scales than the fortunes a wealth tax would primarily affect, and that someone deciding whether to found a company is responding to entirely different considerations than someone managing an already enormous, multi-generational fortune. This is, genuinely, an area where thoughtful people, looking at similar evidence, reach different conclusions, often depending on assumptions that are very difficult to test directly. Let's bring in a real-world example here, because I think it illustrates just how genuinely hard the implementation side of this is, separate from whether the underlying idea is good or bad. Several European countries did experiment with annual wealth taxes at various points across the 20th century. By the early 2000s, the number of countries in the OECD still operating a general annual wealth tax on individuals had fallen to a small handful, with several having abolished theirs over the preceding decades. The reasons cited, in the countries that abolished these taxes, very often centered on exactly the practical issues we just discussed: administrative cost relative to revenue raised, concerns about capital flight as wealthy individuals or their assets relocated to jurisdictions without such a tax, and the genuine difficulty of valuing certain types of assets fairly and consistently. At the same time, it's worth noting that the countries that abolished these taxes didn't, generally, see wealth concentration fall as a result. If anything, concentration in many of these countries has continued the broad upward trend we discussed in Part 1, suggesting that whatever role these specific wealth taxes were playing, it wasn't, on its own, sufficient to reverse the broader R versus G dynamic, at least not at the rates, and with the exemptions these taxes typically involved. Which leaves us with a genuinely open question. Was the problem with the idea of a wealth tax, or with the specific, often quite narrow and exemption-riddled, design of the wealth taxes that were actually tried? Proponents of the idea tend to argue the latter, pointing to design features like low rates, generous exemptions for certain asset classes, and lack of international coordination, as the reasons these specific experiments had limited effect, rather than evidence against the underlying logic. And this connects to something that has, genuinely, moved from academic discussion into live international policy debate in recent years: the idea of international coordination on taxing extremely wealthy individuals. Various international forums and groupings of countries have, in recent years, discussed proposals for some form of coordinated minimum standard for taxing the wealthiest individuals globally, motivated explicitly by the kind of capital mobility concern we discussed: the idea that without coordination, any single country's efforts can simply be circumvented by relocation. These discussions are, as of now, at a relatively early and contested stage, with significant disagreement between countries about whether such coordination is desirable, and if so, what form it should take. It's a live, unfolding story, not a settled one, much like the corporate tax coordination story we touched on in an earlier lecture. So to summarize Part 4. First, a progressive annual tax on capital itself distinct from income taxes or one-off inheritance taxes, is presented in this chapter as a direct response to the R versus G dynamic, by permanently adjusting the effective return on the largest fortunes. Second, the genuine arguments against this idea include real difficulties around valuing illiquid assets, the liquidity problem of taxing wealth that isn't held as cash, the risk of capital relocating across borders, and genuine uncertainty about effects on entrepreneurial incentives. Third, historical experiments with annual wealth taxes in several countries were mostly abolished by the early 2000s for reasons connected to these practical concerns, though concentration continued rising in these countries afterward regardless, leaving open whether the issue was the concept or the specific design. Fourth, international coordination on taxing extreme wealth has moved from academic proposal toward live, if still early stage and contested, international policy discussion in recent years. In our final part tonight, Part 5, we're going to step back from the policy mechanics and ask a broader question. What does Piketty himself see as the stakes here? What does he think happens if nothing changes? And how should we think about the genuine uncertainties in projecting any of this forward by decades or longer? See you in Part 5. Part 5. What happens if nothing changes? SDAKES projections and open questions. Welcome to our final part tonight. We've covered the historical shape of wealth concentration, the R versus G mechanism driving it, the old versus new money question, and the policy debates around a progressive capital tax. In this last part, we ask the question that I think gives everything else its urgency. What does this research suggest happens if the underlying dynamics simply continue without significant policy intervention over the coming decades and into the next century? And I want to say up front, this is the part of the discussion where the honest answer is, we don't know with any precision. Long-run projections about something as complex as the distribution of wealth across multiple countries over 50 or 100 years are inherently uncertain, and anyone who tells you otherwise is selling something. But that doesn't mean projections are useless. They're useful the way a weather forecast is useful, not as a certainty about what will happen, but as a statement about what the current trajectory implies if the underlying dynamics don't change. And knowing what the current trajectory implies is genuinely valuable, even if, or especially because, the whole point is to decide whether you want to let it continue or not. So with that caveat firmly in place, here is what the research suggests the current trajectory implies. If growth rates in rich countries continue to slow toward 1% or below, as demographic trends suggest they might over the coming decades, and if saving rates stay roughly where they are, and if R continues to run at something like its long-run historical average, then wealth-to-income ratios in rich countries will tend to continue rising toward and potentially beyond the levels seen before the First World War. And if wealth-to-income ratios continue rising without any significant change in the distribution of ownership of that wealth, then the share of total wealth held by the top 10%, and especially the top 1%, will tend to continue rising as well, potentially back toward, or even beyond, the concentrations of 1890 or 1900 that we discussed in Part 1. Let me put some actual numbers on this, because I think abstract trajectories are less vivid than what the arithmetic actually implies over a generation. If the top 1% share of wealth grows from, say, 25% today, which is roughly where several rich countries are around 2010, toward 40 or 50% by 2050 or 2060, that's not a modest change. That's a qualitative shift in what kind of society you're living in. At 25%, the top 1% is very wealthy relative to everyone else, but there is still a meaningful middle class owning a significant share of the pie and having the kind of economic independence that comes with genuinely owning something. At 40 or 50%, the the dynamic starts to look much more like the world of 1890, where the economic life of the vast majority of people is substantially shaped by decisions made by a very small minority who own the majority of productive assets. Now, does this have to happen? No. And this is, I think, one of the more important points to take away from all of this. The trajectory we're describing is a conditional projection, conditional on the underlying dynamics not being significantly altered by policy. History is full of examples of trajectories that looked, at a given moment, locked in, that were then altered, sometimes dramatically, by policy choices, by technological change, by social and political pressures that built until they produced something genuinely new. The mid-20th century itself is the most vivid such example. If you had looked at the wealth concentration data of 1910 and simply extrapolated forward based on the then prevailing R versus G relationship, you would have predicted continued rising concentration through the 20th century. Instead, what happened was two world wars, and the political, fiscal, and regulatory responses they triggered, that compressed the distribution more dramatically than almost anyone at the time would have predicted. The projection turned out wrong, not because the underlying arithmetic was wrong, but because external shocks, and the policy responses they enabled, altered the arithmetic itself. Which raises a genuinely uncomfortable question, one that I think Piketty is quite honest about, even if it's not a comfortable thing to say. The dramatic compressions of wealth concentration in the 20th century happened, substantially, because of the two world wars, and specifically because the scale of destruction and social disruption those wars caused made levels of taxation and redistribution politically possible that had been impossible in the preceding decades. In other words, the most effective compressor of wealth inequality in modern history was also, simultaneously, the most catastrophic sequence of events in modern history. This is not, obviously, an argument for war. It's an observation about what it has historically taken to overcome the inertia of deeply entrenched wealth concentration, and it suggests that the peaceful, democratic policy tools we have available to us, progressive taxation, coordinated international regulation, are tools that have never yet been fully deployed against the underlying arithmetic, to anything like the extent that the 20th century's catastrophes inadvertently were. Let me bring in one more piece of the forward-looking picture, one that is genuinely new relative to anything the research could have anticipated even a decade or two ago. The emergence, at extraordinary scale, of artificial intelligence and automation as forces that could materially reshape the capital-labor relationship over coming decades. The most relevant question for the dynamics we've been discussing is not whether AI and automation make the economy more productive. They probably will to a degree. The relevant question is, who owns the capital, the systems, the intellectual property that drives this productivity? If the productivity gains from AI accrue primarily to a relatively small number of owners of the companies developing and deploying these technologies, then AI could, in principle, accelerate the R versus G dynamic we've discussed by generating high returns for a concentrated ownership base, while the benefits to workers and to the broader economy, while real, remain smaller in relative terms. Alternatively, if these technologies prove to be tools that meaningfully raise productivity across a broad range of sectors and income levels, including for workers at many points in the distribution, the effect could be more widely shared. Which of these scenarios is closer to what actually unfolds is, genuinely, one of the most important and most uncertain empirical questions facing the field over the coming decades, and I don't think anyone can answer it with confidence today. There's one final thread I want to pull before we close, because it connects directly to something many of you are probably experiencing or watching in your own lives. The question of what inheriting wealth in a society where wealth is increasingly concentrated actually feels like, from the inside, for the generation doing the inheriting. Not at the level of vast fortunes, That's a small enough group that it's not most people's experience. But at the level of housing, as housing values have risen dramatically relative to incomes in many rich cities, a very significant transfer of wealth, often in the hundreds of thousands of units of currency, is quietly underway in family after family, as the generation that bought houses 40 or 50 years ago at, relative to incomes, a fraction of today's prices, ages and eventually passes those assets on. For recipients of this transfer, it often doesn't feel like inherited wealth in the grand, aristocratic sense. It feels like help from parents, or a modest inheritance that lets you do something practical, buy a flat, pay off student debt. But in aggregate, across millions of families, this is precisely the patrimonial dynamic, wealth accumulated in one generation shaping the life chances of the next, that we've been discussing all evening. And it creates a genuine divide, one that is, by some measures, widening, between those whose parents or grandparents are in a position to transfer something meaningful, and those whose families have nothing substantial to transfer. This divide is not primarily a divide between the very rich and everyone else, in the way that top 1% concentration figures describe. It runs through the middle of the income distribution. Two people with similar salaries, similar qualifications, similar careers, can end up in very different financial positions by middle age, depending largely on whether a parental transfer happened or not. This is, in the most everyday kitchen table sense, what rising wealth concentration and the return of patrimonial dynamics looks like, not at the level of billionaires and aristocrats, but at the level of whether you can afford a deposit on a home in the city where you work. So to close tonight, and to bring together everything we've covered across all 5 parts, wealth ownership has always been, and remains, far more unequal than income. The top 10% own a large majority of private wealth in every country studied. The bottom half own very little. A patrimonial middle class, owning a meaningful slice, emerged in the mid-20th century for the first time in history, and while it has not disappeared, its relative share has been under pressure since the 1980s. The R versus G dynamic, operating across 2,000 years of history, explains why this concentration tends to persist and grow absent significant disruption. New fortunes, built in a single lifetime, are a real and genuinely new feature of the modern economy, but they become subject to the same R versus G logic over subsequent generations. A progressive capital tax is a coherent policy response to the arithmetic, but faces serious practical and political challenges, and international coordination would likely be necessary for it to work as intended. And the forward-looking trajectory, conditional on no significant policy change, points toward further rising concentration, potentially approaching pre-First World War levels in some countries by mid to late century, with AI and automation adding a layer of genuine, unresolved uncertainty about whether that trajectory accelerates or is softened by broader productivity gains. None of this is destiny. Policy can change trajectories. History has shown that dramatically if painfully. But recognizing that a trajectory exists and understanding the arithmetic that drives it is the necessary first step toward any serious conversation about whether to let it continue or to try to alter it. That is what this research is trying to give us, not a political program, not a guarantee of any outcome, but a clear enough view of the underlying arithmetic that we can, at least, make these choices knowingly, rather than sleepwalking into a future that turns out to look much more like 1890 than 1960. Thank you for staying with us through all 5 parts tonight. That concludes our lecture on Chapter 10.